The stock market is often seen as complex and risky, yet it remains one of the most effective long-term wealth-building tools. While many investors fear volatility and potential losses, much of that anxiety comes from misunderstanding how markets behave. 10 core truths help clarify how the stock market really works and what investors should expect. 1. Long-term investing wins. History shows that the stock market consistently recovers from crises. Despite wars, recessions, and pandemics, long-term returns have remained positive, and no 20-year period since 1926 has produced a loss. 2. Short-term losses are normal. Even in strong years, markets often pull back sharply. Temporary drops, sometimes sudden, sometimes slow, are part of ordinary market behavior and should not be mistaken for permanent loss. 3. Average returns are misleading. Although the market averages around 10% annually over long spans, yearly returns rarely match that number. Instead, outcomes swing wildly, proving that predicting next year's performance is nearly impossible. 4. Upside potential beats downside risk. A stock can only fall 100%, but its growth has no limit. Over time, markets have multiplied many times over, demonstrating the powerful compounding opportunity for investors who stay invested. 5. Earnings determine long-term prices. Stock values ultimately follow company profits. Economic news only matters in terms of how it influences future earnings, making business fundamentals central to long-term performance. 6. Valuations don't forecast short-term moves. While valuations can hint at long-range returns, they offer little insight into the next 12 months. Over short periods, expensive stocks can keep rising and cheap ones can fall further. 7. Worry never disappears. There will always be reasons to hesitate: economic concerns, political tensions, market noise. Risk is permanent, but rewards exist because investors take that risk. 8. Biggest threats are unexpected. Common risks are usually priced into the market already. It's the overlooked or unforeseen problems that cause the most disruption when they suddenly appear. 9. Market leadership changes constantly. Just as companies rise and fall, the stock market evolves. Old leaders exit while new innovators enter, and many of the biggest returns often come from fresh, fast-growing businesses. 10. The market isn't the economy. The stock market reflects large corporations, not the entire economic landscape. Many of these firms operate globally, meaning they can grow even when domestic conditions are weak.